It's been almost 2 years since I started buying the NEOS S&P 500 High Income ETF, ticker SPYI. Up until then, I had been holding a different covered call fund on this index, which was XYLD by Global X. Although SPYI was still a brand new fund back then, I could already tell that it had a lot of potential. And after selling out of XYLD and putting the proceeds into SPYI, it didn't take long for it to become my favorite high-yielding monthly dividend ETF. And it's been really great that we're now constantly getting brand new high-yielding funds. Fund managers, and even the big ones like JP Morgan and Goldman Sachs, are realizing that investors want high-income paying investments and that we want more options than what we've historically had. As I regularly say in my videos, the ETFs that I like and that are my favorites today could be replaced by new funds with better strategies tomorrow. And not too long ago, there was a new ETF launched that I think gives SPYI a run for its money. It offers a somewhat similar amount of upside as SPYI, but it also comes with a higher dividend yield. The fund we'll look at today is the TAP Alpha SPY Growth and Daily Income ETF, ticker TSPY. This is by a company called TAP Alpha, which is a brand new company and it's currently their only ETF. So when you go to their website, it's just the fund page for TSPY. According to this fund's description, the TAP Alpha SPY Growth and Daily Income ETF seeks current income while maintaining prospects for capital appreciation. The fund's secondary investment objective is to seek exposure to the performance of the SPDR S&P 500 ETF Trust, subject to a limit on potential investment gains. This is very similar to SPYI's description, and it also charges the exact same expense ratio as SPYI. You'll also likely notice right away that TSPY comes with a 14.42% dividend yield, and it pays distributions monthly. As of the making of this video, SPYI currently touts a 12.5% dividend yield. But as I'll go into more detail here soon, this slightly higher yield comes with some more risk compared to SPYI. It says, TSPY, the fintech-powered ETF designed to capture S&P 500 performance and daily potential income generation. Fintech-powered refers to the use of advanced financial technologies to enhance, enable, and deliver our financial products and services. Tech-enabled services and businesses use technology to improve efficiency and innovation. They can include a combination of human expertise and technology to streamline processes, increase accuracy, and provide new insights. And then below that, it lays out some benefits, which can honestly be applied to just about any covered call fund, not just TSPY. It provides upside growth, but it's going to be capped given the nature of writing covered calls. It provides high income, diversification, and flexibility, but I'll go into more detail on this later. Moving on, we can start by looking at this fund's principal strategies. It says, this fund is actively managed and it seeks to achieve its investment objectives through the use of a call option strategy that combines a long position in SPY, an ETF designed to track the performance of the S&P 500 index, with short positions in certain call options. If we look at this fund's list of holdings, we can see that it lists only one item, which is SPY, the SPDR S&P 500 ETF. This is one way that TSPY is different than the NEOS fund. SPYI has more flexibility as its fund managers can employ different strategies depending on the current conditions of the market. TSPY doesn't appear to have the same amount of flexibility in their strategy. But now we get to the biggest difference between TSPY and SPYI. Continuing down their principal strategies, it says, the strategy is a daily covered call option strategy that sells out-of-the-money call options with 0 days to expiration each day, known as a daily call. Daily call options having 0 days to expiration are also known as 0 DTE options. In general, an option is a contract that gives the purchaser of the option, in return for a premium, the right to buy from the seller of the option the security underlying the option at a specific exercise price, also known as the strike price, at a specific expiration date. Through this call option strategy, the fund sells or writes exchange-traded call options to generate income from option premiums. So TSPY is a 0 days to expiration ETF. This means that it's similar to QDTE and XDTE by Roundhill. This strategy involves writing call options in the morning and then closing them out before the end of each day. But if TSPY is similar to the Roundhill funds, what explains its much lower dividend yield? QDTE and XDTE both yield over 30%. The answer is that TSPY is not a synthetic covered call fund, whereas the Roundhill ETFs are. It actually owns the underlying index, whereas the synthetic funds don't actually own the index and instead try to replicate the index's movements using option strategies. Although it doesn't yield as much, it does result in TSPY having significantly better share price growth compared to these synthetic CC funds. I'm currently not aware of any other 0DTE funds that exist that don't use a synthetic covered call strategy, so it's nice to see how these ETFs function when they actually own the index itself. Also, according to this fund's prospectus, it looks like they have another ETF in the pipeline, the Tappa Alpha Innovation 100 Growth and Daily Income ETF. So how does this fund strategy do when compared to SPYI or other 0DTE ETFs? First, looking at its performance to both Defiance's and Roundhill's S&P funds, we can see that there's significantly more upside. Now unfortunately, the yield isn't even half of what these two funds come with, but NAV erosion will likely be less of a concern. So now let's compare it to SPYI. Side by side, the TAP Alpha fund is still trailing behind the NEOS fund, but obviously not nearly as much as XYLD, XDTE, and the other covered call funds. And up until a few days ago, the difference was a lot more noticeable. We can see that just within the last week, something happened that caused TSPY to rather quickly rise in a very short amount of time. I'll be curious to see if this ETF can keep going, but for the majority of the time, it was trailing by a little less than half in terms of share price appreciation. There's also no mention of any 1256 contracts in their prospectus like it does for SPYI, another downside to this strategy. While doing some research on this company, I found something that I thought was really bizarre. I was looking through their website when I saw at the very bottom that they're based out of Seattle, Washington. And as someone who grew up in the Seattle area, I decided to Google their headquarters just to see if I could recognize the area their office is located in. It turns out that their official company address that's listed at the bottom of their website actually isn't an office, it's somebody's house. It's a very nice house overlooking the Puget Sound. I guess it's the CEO's house? I'm just surprised they'd list his address on their website or whose ever house this is. I'm likely missing something here. This couldn't actually be their headquarters. The only thing that matters though is if they're abiding by what's laid out in their SEC documents, and so far, that's what they're doing. So is TSPY, or I guess T-SPY, the NEOS fund killer? I think it's possible. The dividends have also been very consistent and similar to SPYI's. As you could probably guess, my biggest concern with T-SPY is going to be NAV erosion, and for this fund specifically, I think that is going to be a concern. The question I don't yet know the answer to though is the potential for slightly less share price growth during bull markets worth that higher yield? It's a question that'll take time to answer as we watch this ETF develop more of a track record. Now, in a flat market environment, TSPY would outperform SPYI and the index itself because of its dividend yield. I think the TAP Alpha fund is a good consideration if you're okay with being more aggressive and bearing some more risk. I'll keep watching it and see how things play out with it. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.